Hey everyone, welcome to another edition of our Smart Investing Weekly Stock Analysis, where we break down popular companies using fundamental analysis and provide advice that is truly unbiased and has no strings attached to it. We're going to take a closer look today at a pretty prominent company. I'm going to give you that company, but if you like this video, you want to get more access to these videos, be sure to subscribe to our YouTube channel, Smart Investing with Brent and Chase Wilsey. And again, you can kind of go look for different companies that we talk about. But the one we're talking about today, it's actually the second largest company out there. We're going to talk about Microsoft. Ticker symbol, for those that don't know, is MSFT. Some interesting news we saw from Microsoft this week.
Chase, do you think anybody will say Microsoft? Who's that? I think
You know,
everybody that has investments somewhere knows about Microsoft. It's been around for quite a while as well. And I do remember when it came out, I believe it was back in the 90s. And who is this company, Microsoft? And they were doing, on the computer and like, wow, they got these window things. They've come a long way since that time frame.
Oh, absolutely. It's definitely gone up in value quite a bit since the 1990s. That's for sure. And one thing I want to talk about too is, while we're on the topic of Microsoft, is in the 90s. I mean, they were part of the tech darlings. And one thing that a lot of people don't realize is that those people that bought Microsoft at the absolute peak back in the early 2000s, the late 1990s, I mean, it took them 15, 16, 17 years to get back to break even because Microsoft became way, way too expensive. Are we in a similar situation now? That's why we break down the fundamentals here. But also did want to talk a little bit about what we saw this week from Microsoft. And the media pointed it out. Wow, it's so exciting. They're doing a $60 billion stock buyback. And it sounds very, very enticing. If you take a closer look at it, there's some questions here.
Yeah, well, we'll go over the fundamentals with people because again, we do want to go over that. And I always tell people the media is not on your side. Their whole job is to sell commercials, make money. So they want you to get excited about this. They don't want to look at the stuff that we look at to really make you a smarter investor. And you're correct, I think it was like 15 years before people made money on this. And don't think that Microsoft forever and ever is going to keep going up and up and up. And we'll go over the numbers for you. This is where investors lose money. And then they scratch their head. Well, why did I lose money? What happened? Because you weren't watching the business. And that's why we do these on YouTube and why I do TV, the radio, and so forth. So, but let's get into the main part here. We're going to talk about.
Before we get into the fundamentals, I wanted to further explain the stock buyback. We didn't get into that. Okay.
I was going to say that. I was going to go to that because again, as we talk about, we discussed this. We saw it came out, 60 billion. Like, wow, that's a lot of money. And then you can't deny that. But we always talk about a number means nothing at all unless you have something to compare it to. Well, when you compare it to the market cap, you got to say, well, wait a minute here. Does this really make sense? Is it such a big deal?
I mean, not really. I mean, the $2.3 trillion about is what the Microsoft market cap is currently. So you look at 60 billion divided by 2.3 trillion. I'm not going to say it's peanuts, but it's nothing that's really enticing. That's about what is it, 2.6% of the shares outstanding. I mean, it's not anything that's wow, but the media is like, oh, huge buyback, $60 billion. It's phenomenal. And again, 2.6%. Look at another buyback that was actually announced today. I mean, it's funny. It's part of the, FANG stocks are quite prominent. This ticker symbol is FANG, not the FANG stocks. The ticker symbol is FANG. And said Diamondback Energy Company is actually the company that announced a $2 billion buyback. And, the average investor might be saying, well, 60 billion is more than 2 billion. But the difference here is Diamondback Energy, their market cap is just about $15 billion. So 2 billion of the 15 billion is about 13% of the company they're going to be buying back. That's a way bigger buyback for a shareholder than the 60 billion that Microsoft is doing. Again, about 2.6% for Microsoft.
And I actually just gave the viewers here a little preview because we're going to use that next week for our posts and so forth. So we're kind of YouTube viewers. They get to see this first before next week. We're talking about that. But it is true. I mean, I've seen buybacks for companies that, 10, 15%. Those are huge buybacks. That makes a difference. I'm sorry, that's 2.6%. You will not even be able to see the movement in the earnings, I don't believe. And that's why a buyback's so important, because the fact that a buyback, should you buy more shares back, then there's less shares outstanding. The earnings should go up. I don't think that's going to matter here at all. And I also have to point out, Chase, they did mention too that they can withdraw this if they want to, because there are some concerns down the road. But we'll see what happens. And also too, I've been doing this for 40 years. I have seen where they lay those buybacks out, buyback, buybacks out, I guess the way you said, and they just don't do it,
Yeah.
because things change. So don't guarantee it's going to happen. But again, understand what it is, because don't get excited with the media that, oh, wow, $60 billion relative to the other numbers. It means very little at all.
Yeah, I did want to point one other thing in their announcement. They did announce the dividends increasing by 11%. And again, I'm going to say another hyped number, but if you look at that compared to the dividend yield, now they're paying about a 62-cent dividend each quarter. That's a 0.8% yield.
Yeah, yeah. I mean, in today's interest rate environment, it's not bad, but it makes it sound good. Wow, up 11%. Again, you're only going up to, you said, what, 0.8% yield? That's not very much. And sometimes I even wonder why businesses do that, because you won't even notice that dividend. I don't think many people buy the dividend in Microsoft. And I do remember at one point in time, you could get about a 3%, I think even maybe a 3.25% yield off of Microsoft dividend. But as the price goes up, yield goes down. So it depends where the stock goes forward here.
Yeah, absolutely. And, with that, I think it's a good time to kind of get into the fundamentals. I mean, we talked a lot about the buyback here, but let's take a look at the numbers behind Microsoft. And, I think a lot of our viewers can probably already tell we don't like Microsoft. It's just kind of pricey, but here's the numbers to kind of support why we have those feelings about Microsoft.
And Chase, let's be clear. It's not that we don't like Microsoft. We think it's a great business, a great company, great management. We feel that's overpriced, and that's a problem we get into. As an investor, you got to be careful what you pay for. So we love Microsoft, great company.
I mean, we use it. We use Microsoft all the time for their cloud services, kind of short documents, things like that. It's a great service. But again, what are you paying for that service is the question.
Yeah. So good company, just rather pricey. So let's start with that. Let's talk about what we're paying for the price earnings for Microsoft. It is 37.9. Now that is below the industry at 73, but don't get excited. Keep in mind that the average over the last 100 years on a forward PE or PE is around 14 to 17 times. You're double that. So you're not getting this on sale. Even when you look at the price to sales, 13.7, but the whole industry is expensive at 13.2. And you can see that if you just go to the right, you'll see the S&P 500 price to sales, 3.1. Price to book value, 27.2. I'm rounding off here, so if you're not seeing a different number, I'm rounding in my head here as I look at the number. The industry is 106. That's very expensive. And then we do see that the price of cash flow, you're paying 31 times for the cash flow, which is also above the industry of 41 as well. But again, just going out to the average on the S&P 500, 19.8. So again, you're not getting this on sale, and you're comparing a high price valuations to a high price valuation industry. So understand what you're getting into. There's that big dividend, 0.8%. They use 27% of their earnings to pay it out. And I'm surprised that dividend payout ratio is that high, because I thought for that dividend, it might be like a 5, maybe a 10% payout ratio. Pretty high dividend payout ratio. It tells me if they quadruple that dividend to 3.2, they'd have to use 100% of the earnings that paid it out. That kind of puts things back in perspective there. Not that good of a number.
What kind of interrupt you here where you're going is the reason that payout ratio is so high and the yield is so low is because the earnings you're paying for is so expensive. It's all kind of intertwined here. And that's something that concerns me is if you look at the yield, I mean, it's a very pricey company. It comes back to how expensive those earnings are for the business.
That's right. Yeah. So, and again, because of the price of the stock. So
well, kind of to kind of put this in perspective, if Microsoft were to get cut in half, which again will kind of bring it to a longer term average there, well, now the dividend would be 1.6%. So there's kind of two ways to work on that dividend yield, where the dividend payout I don't think is that bad, but it's just the price of the stock so expensive.
Expensive. Yeah, you're right. You got to look at many different things on the numbers. The numbers tell a story, but you got to understand how to read those numbers. Moving on to the growth rates for the company, we do see year over year sales growth was up 17.5%. That's about the same as the industry at 17.68, which kind of worries me because you are paying a lot more for the earnings and the sales of this company than the industry, but about the same there. Taking a look at the earnings per share growth year over year for the last 12 months, looking pretty good, 39.7. That is above the industry growth at 19.4. They've got a good balance sheet. I think they always have had a good balance sheet here. Got a current ratio of 2.1 versus 1.9. Just shows the company has a lot of liquidity, which they must have because they're going to spend out $60 billion for this stock buyback. I think they have, if I remember correctly, 100 or maybe even $200 billion in cash. So a very liquid company. We're not worried about a liquidity crunch. Even the debt to equity looks pretty good at 49.8 versus 69.4. So that's a positive on the balance sheet. Look at the return on equity. Well, that's very, very high, 47 versus 23. Now that could be very high because perhaps the equity is very low. So you got to check the balance sheet to see, is there equity declining? Because again, when you do stock buybacks, that does reduce your equity because you're reducing your assets. Don't get too confusing for people, but kind of point out conceptually, that may not be a great number, even though it looks pretty good. Kind of understand that number. Net profit margin is very good, 36.5, double the industry at 18.2. And then also for a company like Microsoft, receivable turnover is important. You want to make those sales, collect the money. A little bit low, 4.8. I say that because the industry is at 6.5. We're looking at inventory turnover 23 times over the last 12 months. That is better than the industry at 19.6. And this is when you do want higher. You want to keep that inventory turning over out the door so you can collect the money and go on and use that money to research more and develop more and make more sales and everything else.
And I was going to take a look here. Obviously, we know it is a technology company, but looks like they're in software and software programming. And I know software, the thing people always talk about is, oh, well, it's reoccurring revenue. It's reoccurring revenue. And that's why you should justify the higher multiples there.
And I know you want to go on here too, but I just got to point that out. We're in a very good economy right now, and that is reoccurring, revenue. But I guarantee you, when the economy starts slowing down, there will be ways that they're going to kind of cut, try to use different things. So don't just think, oh, it's recurring revenue is going to be great forever, because when things slow down, and they will at some point in time, this company could have a difficult time increasing the revenue.
Well, no, I just think it's kind of an excuse to justify a higher price. And you see that in the past where people say, oh, well, it's Microsoft, so it's just going to keep going up. And, you've seen it happen throughout history, and people are going to think I'm crazy here, but, people used to say the same thing about Sears. And, oh, how great Sears is. It's such a great, great company. And some people might even be saying, who's Sears?
I know, exactly.
It's a retail company, and they were just dominant in the 90s. But guess what? Nothing stays on top forever. And the same thing can happen to Microsoft. It's reoccurring revenue until some competitor comes in and they steal that reoccurring revenue. That could be a big problem. And now you can't justify the high valuations. With that said, though, let's take a look at kind of our valuations going forward, what our target sell price would be. To begin, though, I do want to give the current price. This is based as of yesterday. Current price is $305.22. It is trading right near its 52-week high. Now, they got a little bump after the buyback announcement to $305.84. Look at this 52-week low of $196.25, done very well off those lows. But I got to June 2023, and I see estimated earnings per share of $10.05. That would give me a target sell price of $166.83. I mean, it's just so pricey that this company is trading at over 30 times the future earnings. And as you said, the long-term average, 16.6. So I'm going to say darn near double that long-term average. It's expensive. That's all I can really say about Microsoft. And I don't think people that bought it, they may have doubled their money. I don't see this going to $600 a share. I mean, that would put them at a 4P of 60. Right. Where's that multiple expansion going to come from? Can they maintain earnings growth, and maintain this high multiple? I don't see that.
And Chase, the other thing I want to point out for the viewers as well is look at those numbers going back to June 2020 and June 2021. You can see on the earnings per share pre-exempt, you see them June 2020, $5.44. Now, again, that was during the pandemic, but you had great growth for 2021 up to 780, then 780 to 877. I didn't figure out on a calculator what that percentage is, but it appears to be a bigger percent than the growth. And actually, the growth from 877 to 1005 to June 2023 looks good as well. Look at the growth perhaps to 2024. Maybe that growth is slowing down by 2024 because it does not appear to be. I didn't do the math on it, but the percentage growth in the earnings does not look as good as it did over the last 2-3 years here.
Yeah, I mean, it looks like it's averaging about 10 to 15% about on earnings growth. So I mean, it's a growing company, but I just at what point that growth stops? And
Yeah,
two, the other thing too is, I mean, it's hard to grow big numbers. You know,
right.
you kind of start to run up against a difficult time period because the numbers get harder and harder to grow. I mean, you can only have so many customers, you know,
Yeah,
you can't have every customer in the world.
yeah, yeah, and it's much easier to grow earnings when they're lower than when they're higher. And we're just kind of pointing things out for the viewer there, for the investor to kind of work out that number. Maybe I'm wrong. Maybe the percentage growth is higher, but we don't.
It's slightly higher. Yeah,
Is it like
actually, yeah,
even going from
it's
23 to 24? You think? Okay,
uh, yeah, no, it was 15. It was 15% versus like 14% or somewhere in that realm. But I did check the numbers. It was slightly higher
okay.
for next year versus this year. So,
Well, that was this year versus
and
last
then,
year,
well, then no, then the following year versus the next.
23 to
Yeah,
24 as well.
it is
Okay,
slightly higher. But I mean, I don't want to knock Microsoft. It's a great company, and they've done a great job growing. But again, these are estimates. They're not foolproof by any
right.
means. So
And we talk again about the last 100 years. The average for the PE ratio is around 14 to 17. Everything goes back to the norm. And someday that's going to happen. Microsoft could be tomorrow, could be next week, next month, maybe 3 years from now, who knows? But just understand if you're holding that company, you're buying it, you could be paying a high price for it.
yeah, yeah. So point is, I mean, the Microsoft could go higher. Absolutely could go higher, but
Yep.
I wouldn't be buying it. It's just it's too expensive for how we invest. So with that said, we do want to thank you for joining us today. If you like the content, please be sure to subscribe to our YouTube channel for upcoming stock videos. This should not be used as investment advice, as it's for informational purposes only. If you're interested in learning more about our investment philosophy, please visit our website at smartinvesting2000.com. Again, that's smartinvesting2000.com.